Right, Jack, what's the worst thing you've forgotten? And the reason for that question is, over the weekend, my wife's best friend turned up. My wife is godmother to her daughter, and she only realised when she sat down in our living room and looked at the mantelpiece with all the birthday cards that she realised she'd forgotten her supposed best friend's birthday from a week ago, and then went out and had to buy a gilt, like, Colin the Caterpillar cake to make up for it.
The worst thing I've forgotten on a similar theme, and I think this goes to show just how dedicated I am to the industry. 12 years ago, I hadn't realised that my son's first birthday clashed with the Agri-Scott event. And what do you think I did? Do you think I stayed at home and built the garage for a 1-year-old? Or do you think I went to speak at said conference?
You took one for the industry team.
And every year, November the 21st, I get reminded. Hello, welcome to Agonomics with David and Jack.
I'm David Udall.
And I'm Jack Watts.
This podcast, looking at the economics of agriculture, has been growing, courting attention beyond our borders with listeners around the globe.
Bonjour.
Guten Tag.
G'day.
And konnichiwa to the one person who downloaded an episode in Tokyo.
Hardly big in Japan, but it's a start.
Each week, we look at some of the great work AHDB has been doing.
In this episode, our focus is on the input cost review.
The likes of feed and raw materials, sustainable soy, straw prices and gas market anxiety will all be covered.
So, plenty for everyone.
Regardless of sector.
Please follow or subscribe to this podcast to make sure you don't miss an episode.
New shows drop every Wednesday at midday, and please get in touch.
Comment on any of AHDB's social channels.
Or email us agonomics@ahdb.org.uk and let us know where you're listening. So we've moved into September, and that's an important month for the economics and analysis world of AHDB because we're actually doing a bit of a mini review and looking for feedback in what we're doing. So in all of the main outputs and emails that we send out, as well as any contact that we have with levy payers and stakeholders, we're going to be sending out a short survey asking for how much they value their work, what they use, if we could improve, just to basically get a bit of a view on where we can move forwards, where we can improve, and where we can make sure that everything we're producing is top-notch and of biggest value to our levy payers. So if you see the link, please do fill it in. It's hugely valuable for us to get that feedback so that we can constantly adapt and develop and evolve what we do. We're always talking about the market situation developing on this podcast and how things change over time, and we as AHDB need to make sure that we change with it so that we're providing the best economic and analysis information to our levy payers and to our stakeholders. So please do get involved and click on the link if you receive any of our main weekly outputs or any key emails that go out. And yeah, let us know what you think.
The Agonomics inbox was empty this week, so we've been tracking more of the emails intended for our colleagues in the comms team, purely for our amusement. Sadly, nothing of interest, although we have learnt it's the London Dentistry Show next month. So polish up your pearly whites.
And we've both been given a mystery word, phrase or thing that has no right to be in a podcast about agriculture or economics to try and slip in unnoticed. We're pretty good at slipping them in, but pretty useless at spotting each other's. So I hope our listeners are doing better than we are.
So in this week's episode, we are having a little bit of a tour de force around some of the key inputs of agriculture and really understanding how those costs have changed and then how those costs are linking through and relating to outputs, because there's some really important relationships there. Things are changing over time, and it's really important to stay across those changes. So we're going to start with looking at animal feed, raw materials, because it's been a tremendously volatile time for the feed market over the last few years. So if we look to start with at the cost of animal feed raw materials, so the grains and the protein meals and the such, and if we look at how their levels of usage, we can weight them into basically a price. So at the moment, we can look at that price and the sort of the overall average cost of raw materials going into the GB feed ration stands at around £210 a tonne. That's been reasonably stable in the last few weeks and months. But if we remember that just 2 years ago, following the outbreak of war in Ukraine, that was £310 a tonne roughly. And so it's come down tremendously to relatively more normal levels. So hopefully it's spelling an improved picture for certainly those intensive livestock sectors.
On that, Jack, one thing that we've spoken about, not necessarily on this podcast, but in other forums quite a number of times, I suppose, is the ability for each individual sector to hedge forwards and sort of protect their feed costs. And it's kind of different across each sector because of the way that they work. And do you think that there's been a change in the way that people perceive the feed cost and are actively managing it within their business, considering that we've seen that big change in recent years? Or do they treat it as like, oh, that was a bit of an extreme, painful couple of years, glad we're out of that, and carry on as normal?
The events of the last few years has kind of, as we saw, I think, back in 2007-8, when wheat for the first time reached £200 per tonne, I think this has been another refresher of, we didn't think before that the market could do anything like this. Now we know it can. And so we now know that actually there's a whole new degree of risk management. And certainly we're seeing in the industry as a whole and sectors as a whole are taking approaches. So if you look at poultry, for instance, a heavily integrated sector, and so feed price volatility is essentially managed by the whole chain. We're starting to see that emerge in the pork sector now. It's an area in the dairy industry as well, where dedicated supply chains are sharing that risk of feed as well. And I'm fairly convinced that at an individual business level, that has to be on people's radar. And there's a greater need then to support that decision making with good information so that people can make those informed decisions. I think one of the other interesting bits is how that relationship between those big feed raw materials and the compound feed prices, there's not a huge amount of visibility on compound feed prices, which I think is a shame. So I guess the best resource we have is what DEFRA publish. They publish quarterly prices, but they're quite generic. So they publish an all cattle feed price and an all pig feed price as well. And they generally follow the trends in those raw materials, but there is some important nuance as well. So those finished feed prices haven't necessarily been as fast to fall as the broader raw materials since sort of the peak of the market a couple of years ago. I think that's partly because feed compounders had to take a hit in margin to sort of maintain demand, maintain business. And so when the market started going up originally, the finished feed price wasn't going up anywhere as near as quickly as the compound feed prices. But I think we need to remember that production costs, principally energy, is a major factor of that as well. For the first time ever this year, in the DEFRA compound feed data, we've actually seen the price of pig feed fall below the price of cattle feed. I think that's a sign of the consolidation we're seeing in the pork side of the market.
Yeah, that's an interesting one. And that kind of leads me on, I suppose, to another point that we were going to talk about, and something that's definitely going to be a challenge across all sectors, but is more pronounced in those like pork, where they have a greater reliance on, or rather a greater usage on the proteins and soy in particular. But we are seeing a significant change in the soy market coming up from the new year onwards with regards to deforestation regulations coming in from a European level and a UK level, which basically is putting the entire soy market on pause at the moment for January onwards. There's a lot of uncertainty with regards to how these regulations are going to be in place. Basically, you need to prove that where your soy is coming from is not been from deforested areas, etc. And the ability to do that is pretty tricky in the supply chain because of the way that mass balancing works. And so it's an impact on a global level that's definitely coming back to impact a UK farm gate. And that's, again, what we were talking about last week, isn't it, in terms of these sort of macroeconomic impacts coming down to impact a single farmer. So that's going to be a considerable challenge, and is something that, again, may create one of those volatile periods in price, especially because obviously from a UK perspective, we're so heavily reliant on importing for our animal feed usage, the significant proportion of the protein that goes into it, because our domestically sourced protein, such as rapeseed and peas and beans, have either been reduced because of the impact of the change in neonicotinoids and the reduced oilseed rape area, or probably is an equal competition to SFI now from a pea and bean perspective. So it's a challenge, really, I think, longer term from a domestic perspective in terms of protein going to animal feed. Where is it going to come from? Short term, there's uncertainty because of the sustainable soy and deforestation impact, but longer term, and again, we've spoken about food security previously as well, haven't we? In terms of that balance of self-sufficiency, if we've got a market which isn't producing as much oilseed rape, therefore isn't producing as much rapeseed meal, and something that is incentivising a move away from what are deemed as sort of minor crops because of their area, like peas and beans, it puts a lot of pressure on the feed system in terms of where is that protein going to be coming from.
Yeah, the whole theme of protein into animal feed and protein through to consumers is a massive area, one where there's going to have to be a lot of development. Deforestation regulations coming in, I think, creates a real price challenge, not just because it means prices will be higher, but I'm going to use one of my favourite phrases, price discovery. How do you discover what the actual market value is for a tonne of deforestation-free soya? It's easy for normal soya, let's call it that, because there are futures markets around the world, and it's basically calculations of logistics to ship it to a particular country. And people say, okay, well, it could just have a premium over the futures market. Yep, I agree with that. But how do you discover what that premium is? Clearly, nobody wants to be going out and bidding up the market and then realising that they've bought uncompetitively. So I think the risk is that we're developing this standoff in the marketplace, and so it's going to be a challenging time, I think.
And speaking of challenging times, something that we've seen but has actually kind of recovered is the pig prices relative to feed. Definitely recovered, but from a pretty awful place.
Yeah, I'll always advocate the use of a good ratio, because it just gives a very, very basic metric to show the value of something versus the value of something else. And those very ratios are barely static, and they're really important and can tell us in a nutshell what's going on. So the ratio for this I want to consider is the amount of feed raw materials that 1 kilogram of pork will buy. So if we just get ourselves a bit of historical benchmark. So if we look into the years of 2017 to 2019, 1 kilo of pork would buy about 8.4 kilos of feed raw materials on average. So the way to look at the higher the ratio, the better, because then 1 kilogram of pork is buying more and more feed, and so is indicative of better economic prospects for the sector. Now, there's a lot of nuance in there. There's a lot of other costs, clearly, but we appreciate feed is the most volatile part of feeding the pig and the biggest cost, and we can sort of start to see how that can be used as a bit of a proxy. So back in that base year, 8.4, and if we go forward to 23, that had fallen to below 7 kilos of feed raw materials bought with 1 kilo of pork, because the feed price had shot up because of what's happened in Ukraine and the massive pork market challenges that we were seeing because of the backlogs on the international market, availability of butchers, etc., to do that. However, there is light at the end of the tunnel. So we look at how the markets line up now. And so now 1 kilogram of pork will now buy close to 10 kilograms of feed raw materials. So that's great. It's been at that level for a few months now, but I think it's going to have to persist at that level to inject some confidence back into the pork sector and really offset that massive challenging period that we saw primarily back in 2022 and falling out into 23 as well. So there is some green shoots there. But as I said, that's just looking at feed versus pork. There are other challenges as well. Never before, I think, could you have linked electric vehicles to pork markets, but you can because of the trade dispute that is kicking off around the world between Europe and China. And people say, well, okay, the UK sat outside of and is not yet sort of said it's going to put tariffs on Chinese EVs, but we know that there is likely to be consequence of Europe doing that, and the retaliation may well be impacts for the pork market, and whatever happens in the European pork market will undoubtedly impact the UK pork market.
And we've had examples of how those kind of global trade things spread around the world, because we've seen it previously, from a Chinese perspective with like Australian feed barley, and how that's impacted it. Immediately goes around the world in a really short space of time.
Let's segue using barley, because I think there's another nerdy animal feed thing going on. And let's jump to beef. The beef market, as we know, is probably still the most interesting ag market we've got at the moment. Those deadweight prices are close to £5 a kilo, maybe even have tipped over. I don't actually see what they did in the last iteration, but certainly there is some support in the market there as well. And I'm going to go quite traditional because I want to talk about a very traditional system was called barley beef, feeding barley to cattle. Sort of went out of fashion because when beef prices were depressed, and certainly when we came through nearly 20 years ago and we saw grain prices rising away, they rose quicker than beef prices and it became less economic to feed barley into beef. Again, a cracking ratio here. We are going to look at the ratio of the beef price versus the barley price. If we go back to 2019, 1 kilogram of beef was going to buy around 25 kilos of barley. The ratio got really distressed and fell to, at its poorest, when Ukraine was kicking off, grain prices rallied, and so it had fallen from that 25 down to 15. So 1 kilo of beef was only buying 15 kilos of barley. Now, though, on occasion, we've nearly hit 35 kilos of barley per kilo of beef. It has subsided a little bit, has ebbed and flowed, but it's kind of, we are stabilising at above 30 versus that kind of what you'd call that normal 2019 level of 25. And actually, if we can look at the rolling 1 year average of that as well, and that is strengthened as well as that long-term relationship. So I'm suggesting here that there is an economic signal around getting better use of barley. Potentially, if it's in a mixed farming scenario, maybe we'll see more barley being fed on farm or in sort of the local farming economy to be fed directly to cattle because the ratio is there. I think the thorn in the side of it is you can have the barley, but you might not have cattle because we know that there's been some consolidation in the availability of cattle. So the feed economics might look good, but you haven't got anything to feed that barley to, then it all looks a bit irrelevant, doesn't it?
Yeah, and the tricky thing is as well, if you've got to buy the barley in at the moment, if you don't have the barley yourself, I think it's a pretty depressed barley market, trading £25 to £30 per tonne below wheat, very little demand. It's always a weird time of year when you kind of go through September in the barley market because a lot moves off farm through harvest, and then this is the kind of period where people look to sow in winter crops, etc., and have kind of cash crops going out of kind of higher value. So barley always kind of disappears at this point. It always gets quite tight, and I think we've actually hit that point where people are starting to actually having to pay up for barley now to incentivise it to come off farms. And a lot of the grain trade have then sold export vessels and are realising that as the barley market's getting cheaper, all well and good, gets to the point where actually there is no incentive for it to move off farm anymore, and therefore the price has to go back up. So it's a very good time for that ratio, but how long it will stay around if the barley market isn't actually flowing supply, then that'll be an interesting one to see. Maybe we should set up our own tiny barley beef unit, Jack. We could throw a couple of cattle in a conservatory somewhere or something on the back of the house, couldn't we? And we'll be all right.
There's a broader point there. So we've talked about feed into pigs and barley into beef. I think one thing's becoming evident. Getting stuff onto farm and processing stuff, in this case animal feed, is becoming more and more expensive. And I'm kind of wondering actually if there's a growing opportunity to integrate systems on a farm. A lot of our pigs are fed with compound commercial feed. Home milling and production of feed is kind of quite niche in the scale of it, as I understand it. I wonder though if that may well start to change, particularly if these relationships between sort of feed raw materials and finished compound feed sort of remain quite broad, their price differentials. And so I think we may be starting to see an incentive, actually, is it worth investing on farm and materials and the additional nutritional advice that would be needed to shorten that supply chain on farm?
Well, we spoke about diversification because of the impact of losing direct payments. And I think people's view of diversification immediately goes to, can I put up a holiday cottage or farm shop? Whereas actually diversification across sectors, basically everything we talk about is managing risk in a way, isn't it? And this is a way to actively manage your risk because you're spreading your commodity price risk across a number of different sectors at the same time. There's
a very, very strange analogy here, but I think what we need, just before we go to the break, is to start thinking about, does agricultural commodities, particularly input commodities, need to have their own equivalent of a conservatoire so they can learn how to sing with these markets and how the instrumentals will work?
I'd like that. Now all I've got in my head is like a cow playing a harp. What animal would be best in an orchestra? I don't know. We'll have to think of that. Right, let's ponder that as we go for a break and get the latest on the markets. And we'll come back and we'll be talking more about input prices.
Hi, I'm Olivia Bonser, Senior Analyst at AHDB, with a look at grain and oilseed markets for the week commencing the 6th of January. Despite some support in wheat markets over the Christmas period, prices have been under pressure in the new year from a strengthening US dollar, technical selling and sluggish global demand. However, Russian wheat crop conditions remain in focus, with warmer than usual temperatures and excess moisture in key growing regions. Persistent hot and dry weather in Argentina is also raising concern over the country's maize crop, which is now in its critical development stage. For rapeseed, new crop prices are supported, with doubts over prospects for global rapeseed production in 2025, though forecasts of heavy soybean supplies from South America limit any major price increases. Over the next few weeks, weather in major exporting countries such as South America and Russia will be key in driving prices. The USDA will also release updated global supply and demand estimates at the end of this week. To stay up to date with the latest data and analysis across arable, red meat and dairy markets, head to hdb.org.uk and click on Markets and Prices.
If you're in the market for another podcast to subscribe to, then look no further than our Manager's Special, AHDB's Food and Farming podcast. Recent episodes include a consumer insight offering on red meat labels and supermarket aisles, as well as a dairy special about our work with retailers to promote milk. If you're after herbs, or rather herbal lays, our shelves are stacked with sage advice on how to introduce lucerne and clover into your fields. In fact, we cater for all tastes, so you'll find sections dedicated to all sectors: pork, cereals and oilseeds, dairy and beef and lamb. And don't forget our middle aisle, where you can often pick up a bargain episode you didn't know you needed to listen to. Search Food and Farming wherever you get your podcasts. AHDB thanks you for your custom.
Well, as you've been listening to the latest in the markets, thinking about what animal is going to be best in an orchestra, whether you've got a pig playing a trombone, I don't know, pigs and trombones, would that go? Pigs would be oboe, I think, something a bit more emotional. That's what a pig would go for. I like an oboe. We've been talking about what we're going to talk about next, and that is straw markets. The straw is very much a market whereby price creates incentives and it stimulates the market, and that is definitely something we've seen this year, Jack, isn't it?
The important role that the price has played this year is stimulating the decision for arable farmers to bale rather than chop their straw and bring it to market. And so the price has a huge impact of that, because we know that a huge part of buying straw is actually the cost of, again, logistics, getting it onto the farm where it's needed. And so that price signal has to then cover that, but also then incentivise an arable farmer somewhere to bale that straw. Weekly straw prices that get published on the AHDB website, that's been coming down in the last few weeks. The price fall has undone half of the price rally that we saw through last year because of the weather. Will it fall back even more? I think will largely depend on how the harvest, particularly in the north, pans out, and how the weather plays ball in terms of particularly getting spring barley off and getting the straw baled and getting that straw to the marketplace as well. So all eyes are on this, but certainly a lot of the heat has come out of the straw market. Where
I am in Leicester, this is early September. There's still a fair few fields that are yet to be fit. I think some to be cut, because some of those later planted spring crops, that straw just hasn't finished. It's still a little bit green. Yeah, here we are mid-September, and kind of the days are drawing in, and so it's becoming less opportunity, you'd say, for enough dry hours in the day to get straw dry and baled before moisture starts setting in, dew falling and everything else. And we see these as an incentive there for livestock farmers, particularly cattle farmers, to try and keep livestock out for as long as possible, to try and sort of, again, because of the high price of straw, rationing demand for straw and trying to avoid the sort of the relatively high prices. So let's move from one harvest to look forwards a little bit. And this is another thing that I like about commodity markets and about agricultural markets. They are ruthless. They don't have any kind of historic emotion to them. They're not there sort of like longing for a previous year's harvest, as soon as one done, the view is completely switched forwards, going, right, what are planting conditions? What's the world looking like for the next year? Always looking forwards are commodity markets. A key input that we haven't spoken about is fertilizer, and the input for that is gas. And it's a gas market which has been continually impacted by the global geopolitics that we've seen, the tensions in the Middle East, the Russian-Ukraine conflict as well, creating a huge amount of volatility over recent times, and a market that has steadily ticked up as we've gone through this year. It's a bit protectionist, I suppose, in the way that the gas market is operating in some senses, that people are very much trying to just keep their stocks high and use that stock coverage as a protection against any potential future volatility that occurs.
It's almost a highlight of just how, I guess from a price point of view, how isolated the European gas market has become from the rest of the world. So that political objective of reducing reliance on Russian gas, which has been more successful than some across the European economies. The German economy is really going to struggle, I think, to continue to move away from Russian gas. The closer you are to the west, and you've got that greater proximity to LNG coming in from the US, especially, that newfound wealth for fracked gas is actually a pretty important part of energy security for Europe, because although we kind of see gas and crude oil moving in now broadly similar price patterns, you can't really interchange it between your two without kind of major structural changes, and particularly the food industry has a far greater reliance on the gas price than it does on crude oil.
So let's think about how that then follows through to the fertiliser market. And something that I think, from a UK perspective, actually for this year, in recent months, UK produced fertiliser has been relatively steady from an ammonium nitrate perspective. This summer's fertiliser price has just been trading around, £330 to £340 a tonne. So it's been a steady time, which is in some ways is beneficial, because obviously we've seen an extended period of volatility a couple of years ago. But it's also coming at a point where those grain prices have been reducing.
One of the analysts in the Arable team, Gabriel, did a really interesting piece of analysis on this last week, and he described the fertiliser market being between a rock and a hard place. The rock being, okay, well, gas prices are volatile, gas prices are going up, and the hard place being actually farmers are pretty hard pressed to afford to be that worried about the gas price at the moment. A bit like we talked about earlier, we talked about those involved with buying soy having to adopt we're just going to have to wait and see. You could argue that farmers looking to buy fertiliser are saying, well, actually, I just haven't got the means necessarily to buy my fertiliser this far in advance and hold it in store. But yeah, I'm at the mercy of the market, but that's the reality. So, yeah, the gas price is volatile. That's going to impact fertiliser production costs. But at the same time, distributors and producers of fertiliser are going to be very, very aware that there's probably a reduced appetite to buy fertiliser from a farmer demand point of view.
So we've covered a lot, haven't we? We've spoken through a lot of different markets and a lot of different drivers of those markets as well. This is one of those things in a way, it's kind of almost like a mental health thing as well, that a lot of this are things which are out of our control. We can't control the direction of the gas market, but we can definitely control how and when fertiliser is purchased, etc. So I guess with this, it's understanding from your farm business's perspective how open you are to each of these markets in what ways, and coming back to the point you were making earlier, in order to kind of protect your business, protect that risk potential, having a more diversified business that's working across a number of sectors, that kind of circular view of farming is potentially something that actually is going to be providing more security and an opportunity in a world that is far more volatile because of a lot of different reasons rather than just the classic fundamental market-driven reasons.
It's very easy to get rose-tinted spectacles about what farming used to be like with traditional mixed farms, traditional small mixed farms, I think. But the economic reality is that's really challenging. I think, though, there's an opportunity to capitalise from a collaboration point of view. Agriculture is naturally a circular economy in its own right. How animals are fed and the byproducts they produce and everything else like that. So from a crop nutrition point of view, that's a really important thing to think about. But also from feeding animals as well in a competitive market. So I think there's a lot to think about. But I think that getting in that mindset of, right, what do businesses need to do to build resilience against a lot of these externalities of the energy market is important. And there's the added benefit, actually, how can you use something like SFI to do that?
Right, Jack, I'm quite proud of myself this week because I think I got your mystery word. And the only reason I think I got it is because I used mine before you. And I think that Martin, our producer, has been clever and tried to provide us with two words that are extremely similar. So I believe yours was conservatoire.
And therefore, I believe yours was conservatory.
Yes, indeed. It was indeed.
We've got
So
our
we've
full,
got a
our
double
first
win.
full house.
Yes.